GIC RE reported a weak set of Q3 numbers with a decline in the net premium and total income, although the company expects a strong performance in Q4. My colleague Yash Jain caught up with Ramaswamy N, who is the chairman and managing director at GIC RE, began by asking about the quarter gone by and how they see growth going ahead. Listen in.
If you see, our fourth quarter has always been better for us, simply because of two reasons. One, you normally don't have any catastrophes happening during the Jan, Feb, March quarter, both internationally and domestically. So that has always worked for us. So our fourth quarter figures are always better. Second is a lot of accounting adjustments and things like that also happen in the fourth quarter because IRDA had changed the estimation policy this year. So accordingly, if you see quarter on quarter, our figures have been slightly lower because of the estimation policy. On the fourth quarter, everything kind of matches up. So we expect good performance happening in the fourth quarter. So I think investors, I don't want to give a very positive forward-looking statement, but then I think we should be doing better in the fourth quarter. Overall, our figures should be better, and combined ratios we hope will come down by about 3 or 4% compared to where it is today. So we'll be more or less close or maybe slightly lower than what we were last year, but I think it still kind of looks very good from where we are today.
Okay. Now let's start with the third quarter. As far as the premium growth is concerned, at places that faltered, if I speak about the year-on-year premium growth, gross written premium, your gross premium, your net earned premium, they were down anywhere between 10 to 17% on a year-on-year basis, right, and 18 to 22% on a quarter-on-quarter basis. Right. Simply put, what went wrong, and is that addressable?
Yeah. So this was very clear. So if you see, the difference in the premium is mainly in the domestic area, and it happened in the crop insurance business. Now this year the crop insurance scheme changed, where a different scheme came up, and we felt the pricing had become very aggressive, and so we were not very comfortable. So we came out of 2 or 3 programs that we were writing last year, which is the negative that you are seeing in the premium growth this year. But I think the good part is that will positively affect our bottom line, since we are not writing those businesses. So it's good for us.
Okay. As far as the net earned premium for the fourth quarter and for the financial year is concerned, the last time we had spoken, you had told us that you expect about 5 to 6% growth as far as NEP is concerned for FY24. Now, with the kind of contraction that we've seen in the third quarter, do you still stick to that guidance of 5 to 6%, or do you want to enhance it, considering difficult part is behind us and fourth quarter looks good?
No, I would possibly say the growth may not be too much compared to last year, simply because, like I said, there was a contraction in this quarter. But definitely we should be able to reach what we did last year, maybe 1% or 2 growth max. Again, for 23-24, we were not looking for growth. We were looking at consolidating and ensuring that we do what we wanted to do. I think the growth will come in the next years.
Okay.
Right. So if you see, for instance, most of the international business happens on 1st Jan. We have not done much. We have done kind of the same kind of business that we did last year. Simply because even though we got a credit rate boosting, we still wanted it to be A- for us to write the businesses that we wanted. Hopefully, with the credit rating agencies being happy with what we are doing, I think if we get our credit rating to A- this year, then we will definitely write much bigger business in 25. But on the domestic front, so 24-25, the treaty renewals happen on 1st of April,
correct,
where the work has already started. We've already engaged with all the major partners. And we are also already looking at the kind of business they are going to write going forward, what is the kind of support they are looking for, and where we can step in and provide them the support. So this treaty renewals, we hope to grow quite well in this market, and going forward also with risk-based capital coming in, I think it makes sense for cedents in this market, in the Indian market, to write more business with players like us rather than looking at outside reinsurance. So I think for us, the Indian market is an area where we plan to grow quite well going forward.
What are you expecting in the fourth quarter then on the NEP front? And you said FY25 will be the year of growth. I'm not asking you about one particular quarter of FY25, but for the year, what is the growth that you expect in NEP?
So for FY25, we expect about a 10% growth. Because like I said, treaty renewals, we are already going full blast with all our partners. So we typically expect about 10% growth. This is again assuming that prices don't change. The Indian market still behaves the way it has been. We will be more than happy to write a 10% growth in this market. For this year, I think we will end more or less where we ended last year, So it will be kind of flat or maximum 1% change.
Combined ratio, as you said, shot up to about 120 versus 116.
True.
You had guided 109 for FY24. You're saying that won't actually turn up the way it was planned. If not 109, then where do you end FY24? And then FY25, 107, 100, 200 basis points reduction. Would 107 look possible?
So this year, hopefully, we should be somewhere close to 113 is what I would say.
Okay.
Everything being same, because normally our Q4 is much better than other quarters. If we don't have any bad event happening in these 3 months, I think we should do well and we should be somewhere close to 113, 114. Next year, yes, hopefully we can at least shave off a point from what we did last year. And again, depending on how businesses fare in this market, if there are no catastrophes, then yes, I think somewhere close to 108 is something that is definitely on.
Any discussion between the second quarter and the third quarter with the government on any possible offer for sale in FY25? Is the company planning for it? Has there been any initial discussion on this one?
We've really not had a discussion of this kind. Obviously, the government is also looking at how our performance is shaping up, how analysts look at our stock, how investors look at our stock. So that is something which is happening, and we have been very clearly told to engage with investors and analysts on a more direct basis, on a more increased frequency, so that we understand what is the kind of outlook about our stock. We are very grateful that investors have started liking our stock. They've understood what we are doing, and the prices have gone up. So for those investors who joined us in the IPO, it's good to see that they're finally getting into some money. Obviously, like I said earlier, also the government needs to divest 10%. It is something that is mandated, saying that you need to have 25% of public shareholding. So another 10% needs to be divested. When that will happen is something that the government would take. But we are in touch with government officials to understand, and we are ready. The message that we have given to the government is, if somebody wants to come do some due diligence on the company and want to understand from us, want to discuss with us, we're more than happy to do that.
Okay, that is GIC RE in conversation with my colleague Yash.